All right. Welcome, everyone. Today, we're going to talk about how much money you can make buying a business. And I'm very fortunate to have my great friend, business collaborator, brother, Brian Shields, with me today. Brian, how you doing?
I'm doing great, Elliott. I've been looking forward to this all week, so I'm excited to jump in.
Awesome. So I'm going to come from the perspective you guys might not know me. I'm Elliott Holland. I run Guardian Due Diligence. We do quality of earnings. You can think of those as mini audits for business acquirers. My background is in private equity, independent business buying, self-funded search, ETA is what they call it now. And about 5 years ago, I transitioned to be an advisor. And now I work with people typically buying businesses under $10 million to both do this quality of earnings mini audit, but really operate as a deal coach quite often to help people through the negotiation and sort of finer points of successfully executing those transactions. So Morehouse College, Georgia Tech, I picked up an engineering degree I don't use much. And then I have this fancy MBA from Harvard. And I bring all that to bear for my clients. So that's me.
Yeah, no, that's great. And I will add some flowers to that pile. So when earlier, Elliott and I were talking about how the entrepreneurial journey sometimes requires failures in order to get to successes. And, I had launched this entrepreneurial venture with a buddy more than a decade ago now, I think. I'm thinking about it. And I remember we were trying to get access to something, and it was like one of those, hey, who do you know kind of situations. And Elliott was like, here is my Rolodex. It is wide open. I will introduce you to these people, and I will speak positively into your journey. And so, for those of you considering Guardian, I will tell you, outside of the quality of work that you will get, you're just getting a good guy, right? A good dude who's going to be in your corner. And that is invaluable in a process like I will describe now. So I'm Brian Shields. I was the beneficiary of launching a self-funded search. We acquired a company called Hill & Company in 2019 and exited it in 2022 for about 3 times what we paid for the purchase price. So, you can do the IRR, it's high. But more importantly, it was financially successful for myself. And more importantly to me, my business partner who invested alongside me and was in the day-to-day. So I'm very excited to talk a little bit about what it takes to find that and be successful, and also to really just illuminate to anybody interested, is this a financially viable option for your career? The TLDR is yes.
Sure, that's it. So this came from an article that I posted about how much money can you make buying businesses. And in the first sentence, I'm like, well, the answer is pretty easy, millions. But we toss that number around haphazardly sometimes. But I just want to break that down a bit. So someone buying $1 million business with an SBA 7A loan can put down as little as 5% or even 0%, but let's go with 5. So $1 million, 10% would be $100,000, 5%, 50 grand. So with 50 grand, you can take 100% ownership of $1 million business and pay off the SBA note over a decade. And if you're able to grow the business, let's just say you grow the business 0 and you sell it for $1 million 10 years later. You put up $50,000 and now you have $1 million asset, or you've cashed out. Think about the return on that. And that's absent growth. That's, you just didn't screw anything up, or you screwed up as much stuff as you fixed. And so when we talk about these things, I want to be emphatic, because sometimes the number of millions doesn't equate to your $50,000 contribution, because a lot of people have that in the bank, taking over $1 million enterprise and having the ability to take $1 million out. And depending on your spending, you may or may not ever have to work exclusively for money again. And so that's the opportunity that we talk about. And we'll get into some other pieces, because I think this is just the money part. But let me toss it to Brian, because he's lived this self-funded search, and I'm sure has some commentary.
Oh yeah, look, and I love that example you just used, Elliott, because people love to think, let me go buy a house and this real estate will be my nest egg, right? Or I'll buy another property and that real estate will be my nest egg. And that is a viable strategy but it shouldn't be your exclusive strategy, especially for a lot of people who I imagine listen to your content and they understand and they're fairly sophisticated about like generating capital, making decisions about businesses and directions and things like that. When you look at a business, right? Oh man, this one CPA I know said that small businesses are the most effective tax shelter created in the United States. And so in addition to the equity value that you create just by having a business, an asset, and letting the business pay off the debt used to acquire it, similar to a property, right? You can do it in a shorter amount of time, like 10 years is shorter than 30 years. That doesn't account for the scarcity of businesses that may occur down the road. Right now, there is an increase in number of people looking to buy businesses, which means that your business will ultimately be seen as scarce at some point, so that can increase value. That also doesn't take into account the fact that you are going to be able to pay yourself a salary during this time, whereas if you try to do like a startup, you are going to be eating ramen noodles and praying that like, you know, your next round of funding will let you pay yourself reasonable amount of money.
Right.
So there's a lot of other things that come with acquiring an established asset, in addition to the fact that you probably have some level of competency that will help you improve the business, whether it's run more efficiently or grow it, right? And I'll tell you like a high level anecdote, and we can get more specific as the conversation goes. But like high level anecdote, I remember having this conversation with a friend sitting in his kitchen, and he was making this decision about how much more equity to try to buy with his existing company. And he was a employee of this company. He had some equity, and they were about to do a private equity transaction. Candidly, they weren't going to hit a performance hurdle that would make the equity more valuable. And I was like, dude, why would you buy more equity in this company with the hope that you hit this hurdle? How much revenue have you brought to this company in the last year? He was like, about $1 million. One of the growth opportunities they had was to acquire an existing small business that was kind of in their space. And so I was like, dude, you sourced this. How much EBITDA do they make? Or how much cash flow do they make right now? They were making about $1 million. So I was like, look, man, if you brought $1 million worth of business to this business, you would almost double the profitability of that. And so, Elliott, to your point, that $1 million business could easily become a $2 million business just off the work he was already doing for someone else. And by the way, that's what he did. And he leveraged an SBA loan to do it. So, and he refinanced his house. So in effect, he kind of like didn't have to put any money down. And we can have a discussion about like how much debt is really worth carrying, but that's a different conversation. But in a year, he was able to double the EBITDA of the business, doing what he already did, pay himself an almost equivalent salary to what he was getting before, and run a bunch of business expenses through the entity that made his income go further, right? He was able to give tax donations to our college and other things because he had the business entity. So it becomes this multiplier effect of wealth creation that, I just think that folks should be willing to take a closer look at, and we should get more into the specifics. So guide me where you want to go, my man.
Well, I'm just going to go into like the anatomy of $1 million deal, because if it's a $3 million deal, you can just multiply the numbers easily, right? So, and also I'm going to give you a resource you should go check out: The Market for Smaller Firms, which is available in the Harvard Business School Guide to Buying a Small Business. We'll go through this in excruciating detail. It's also a great kind of textbook to have on you if you're really into this. But businesses in this range trade at 3, at the most 4 times EBITDA, which is just earnings before interest, tax, depreciation, and amortization, which is just a proxy for cash flow. So you can't spend revenue at the bank. You got to go spend cash. So revenue minus all the stuff that you got to spend cash on. That's what we're trying to estimate. So let's say a $333,000 EBITDA business trades at 3 times, and now we're at $1 million deal. Okay. Now we talked about adding $1 million to it. So I want to add a couple of things that I think are important to this conversation as we foundationally kind of go through it. Hey, Brian, do you know the default rate on SBA 7A loans?
Oh, interesting. The default rate, meaning how often is somebody unable to pay it back?
Yes.
Unable to pay back. I don't, but I'm going to guess it's probably in the low single digits given the interest rate.
Yes. So I believe it's around 2.3%. So when you think about the startup success likelihood, 10% would be high, right? You have a 5% chance of success. Whereas in buying a business using this debt note that's available at almost all of the banks down the street from you currently, the default rate is 2%. So 98% of people that bet on that note won, and 2% of people who bet on that note lost. So when you think about risk appetite, part of the reason that this movement, and I'm going to call it that, is so pervasive is because everybody wins. It feels like a weird risk. Like, why would somebody allow you to put 5% down on the deal and take all that risk? Well, because it's a 2% default rate. And then if I make $300,000 at Coke and Brian makes $300,000 through his business, I may take home half of that. He could take home 100% of that through the tax shelters in his business. So I maybe go out to the watering hole, if you will, and tout my $300,000 and my bling in the car I'm driving, and Brian may be in a simple polo with his logo of his business on there, and he's doubling me up every year in salary, and he owns equity. So it's a really crazy opportunity when you really think about it. So I want to toss those things on the table, Brian.
No, I love that. I mean, I think that a couple of things to think about, right? The SBA loan, for those of you who want to look up the 7A program. That's kind of like the functional one that is for buying a business. It is a great piece of paper. When pre-interest rates going up, the rate was the interest rate was something like 5% over 10 years, right? That's fairly close to a mortgage. And I think post now, and you probably know better than me, Elliott, but like right now, my understanding is it's somewhere in like the 7.5-ish range. Yeah. Which is great because like, just to give you comparison, when we bought our business, we self-funded and to a certain extent self-financed the first transaction. We bought 2 businesses and we paid 15% on the bridge note that we put in place to get the deal done. So at that time, it would have been a comparison of 5% or 15%. Which one's cheaper, everybody? And by the way, we had 2 years to pay off the first note versus 10 years here to pay off this SBA note. So that means that you have a lower burden on your cash flow, which is meaningful, on the principal, which is massively important. Now, the trade-off, one of the trade-offs is that they highly leverage your existing assets, right? So they'll put like a personal guarantee on your properties and stuff like that. That's a risk that some people aren't willing to take. I know one guy was like in one of my chat groups was like, "Oh my God, like I couldn't handle it." He was like literally sweating buckets during the personal guarantee. But guess what? Most things that you're going to do when you buy a business are going to be personally guaranteed by you. So just like if you can't tolerate that risk, then you're probably not going to be able to tolerate most of the business risk. So I say that to say it's one you should be comfortable accepting. So let's take that off the table. So just to the spirit of your point, right? When you have a business, let's say it's making $333,000, right? Let's assume that a third of that goes to debt service. So that leaves you with $222,000. Okay. Some of that, like the way that income works in a business, to the spirit of your point, is there are a lot of things that can effectively be perceived as business expenses. One example of that would be your car. One of the big mistakes I made too late was we bought a car personally before we bought the business, even though I knew we were buying the business. And I could have leased a car through the business. The note would have been the same every month, but because I'm paying it as a tax deductible business expense, my effective income, right, the perceived pre-tax income would actually be higher, grossed up by whatever I would have netted out for taxes. So, like I think, like if I paid $100 at the company level, that would have been effectively me getting like, I think 1.6 or $160 of salary, right? So you increase your buying power just by having the business. And that's not like this is kind of a funny money kind of like write off. This is a legitimate expense. Additionally, You then have access to different credit programs and points programs. So the business we owned controlled a lot of spend on behalf of clients. We had to pay handyman, we had to pay plumbers, we had to pay tile people, and we've tried to put as much of that as possible on credit cards. Why would you do that, Brian? Hey, has anybody ever written down the number of points that they've gotten on their tax returns? No. But to my earlier point, if you have a business credit card that's going to likely be in Brian or Elliott's name, your personal name, that means Brian or Elliott get to keep the points. So if you are generating $1 million of value and spend a year, and you translate that into points, you then get to keep that. And you know who's going to love that? You're going to love that when you travel. If you have a spouse, your spouse is going to be very happy that you guys get to travel business class. You get access to concerts. You can spend that on other things. Like, there are just additional fringe benefits that come with owning and controlling the asset. And so it is very simplistic and easy to look at. I'm making this much of income at my corporate job, and I get to take my 4 weeks of vacation or whatever, and they pay for my lunches. And then say, oh, but if I own a business, I'm going to quote unquote make half that. But there are a lot of opportunities for you to add on long-term, very tax beneficial ways to create just current income. We're not even talking about equity value yet, but we're talking about current income where your normal day-to-day life will not necessarily change or even improve if you're smart about how you run the P&L of the business. So, I mean, I think that's just like one bucket. And I'm curious, like, what else you've seen in your, deal advisory and post-transaction life with some of the folks you've worked with that show how their lives have improved owning the business.
Yeah. So my favorite customer, and I kind of modeled the business after this guy, 38, wife, 3 kids, had worked in like professional service for 10, 13 years, whatever the number was. He bought a marketing business, used a 7A loan, created agency and autonomy and the ability to be remote. None of the employees were anywhere in the States. There was no office. And so him and his wife and his 3 kids, when they executed the transaction, moved off the coast of Belize on an island in paradise and ran that marketing business from there, and still there. And so these dreams that people have are way closer. And let me just tell you a little bit about this guy. He's no different than me or Brian or anybody that went to undergrad with us, anybody that grew up with us. Smart guy, no doubt, but no Superman capabilities. And so that's what we're talking about. And risk. So risk is something I think as Black people, let me say it differently. Black people, we got to think about risk differently. Got to think about risk differently. And this is from a guy who has failed a lot of times and looked really silly a lot of times. But let's just talk about risk. If you don't buy a business, you don't opt into this zero risk corporate life. So when we juxtapose the risk, it's like, oh, well, I don't want to do the entrepreneurial thing. Business, that sounds complicated. Risk. What's the risk of working 30 years for somebody else? What's the risk of you need to move to some godforsaken place? What's the risk that, hey, it's 2 jobs now. We want you to do it, Elliott. We don't want to pay somebody else. Yeah, I know you got a wife and young. Yeah. Forget that. You got to do this. And what happens to a lot of Black people, we get to upper management, your vice president areas, your general managers and companies, and you just don't get promoted. You had the same job at 7 different companies, not making any more money, and everybody knows you're disenfranchised. So who's going to pay you a whole lot? They know that you're not going to get that next promotion. So there's risk on both sides of this. And Brian talked earlier about the person who sells $1 million worth of stuff. So I'm talking to my mid-30s, 40s crowd, which is a lot of my clients. A lot of us are doing $1 million work for somebody else, and we've developed 15 years, 20 years of competency in this very bespoke, nuanced, highly valuable thing. We have contacts, we've got tricks and hacks, we've got people that we've been at these conferences with and drank too much with, and we have stories that we can't tell, people that have to pick up the phone for us. Access to knowledge is not in the public markets. And so now that we've spent that 10, 15, 20 years amassing that knowledge, one way to de-risk an acquisition is what Brian was saying. Say, my whole world of acquisition targets are going to be within companies that are principally doing the same stuff that I'm doing on my day job. The same exact stuff. How does that de-risk it? You already have sales relationships, you got sales funnel. I mean, you walk into the business with backlog, people who, you know, could as easily use you as somebody else. You ace the bank process because they're like, oh, wait, hold on. This isn't just a normal person buying a business in an industry they don't understand, which they underwrite every day of the week. This is a veteran in the industry who's now using this specific knowledge and was thoughtful about only looking at these companies to go do the same thing he does now, to go do it in a company. So what does your business plan look like? Well, let me take the 6 things that I did this week on my day job. I'm going to go do those 6 things in this business I'm going to buy. And I grew revenue here, average of 30% the past 4 years. So I'm going to take half of that because I'm going to be conservative and put it on this business model over here. And that's what I'm going to do. And so is there risk? Yeah, but there's risk on both sides. And so I think that a lot of us, this is the first time we've seen real money. Might be the first in our generation to see real money, however you define real. And so I know there's a propensity to get it put in the bank, you know, DuckTales, like you're Scrooge McDuck, which isn't bad. This isn't for everybody, but I urge you to consider the alternative, which is maybe bet on yourself the same way your company's betting on you. And so I'm going to pass it to Brian. I'm sure it has some thoughts related to some of those points, and maybe you want to pivot and go in a different direction.
No, I mean, let's just pull on that thread for a second, because I think where you landed is where it's worth emphasizing, right? The companies are betting on you, right? So some company is willing to pay you 100, 200, 400,000, however much they're paying you to do your work. You don't do that unless you are expecting or directly seeing a return in dramatic, outsized proportion to what they're paying you, right? Let's just say conservatively 5 times. So if you are getting paid $250,000 and you are creating value at that company of at least 1.25 million, right? Why not do that for yourself? I think is the point that Elliott's getting at. And I'll tell you an anecdote, man, because this is partially what kicked me out the door to go finally go buy a business, right? So, you know, I started my career in private equity, did that for a while. I came out to the Bay Area and was running growth at these various startups. And my thought process at that time was, well, you know, I think startups are the wave of the future. Technology and technology-enabled businesses are going to be the wave of the future. I want to get close to that and spend some time building a Rolodex, being out front, so that when the time is right, I have the network, right? That was my hypothesis. And I landed at this Series A company, so a very early stage company that was a technology-enabled property management business. And in 2 years, I took them from $500,000 to about $10 million of revenue. And so that was by buying a bunch of little small businesses. That was fixing the sales team and the processes. So we went from $10,000 a month of closed revenue to 100. That was from fixing our pricing model so that we priced the deals appropriately and got more dollars per deal. And by the way, in addition to that, I brought in a VC through my network who helped close a bridge round that they were kind of having a hard time closing. And he ultimately led the C round of the company. So just for simple valuation, the difference between the B valuation and the C valuation was something like $40 million, right? So some part of that value I created by bringing this person in here, not inclusive of the fact that I just 20x'd the revenue over the last couple of years. And I said, hey, I think it's time we talk about promotion. you guys are hiring this other chief something or other with the dude who's had like a piddling track record. Like, here's my track record and the value I've created just here. What's up? And they were like, we just think you need to like sit in the role a little longer. And like, we just need to see what you can do for a little longer before that. And I was like, okay. I did the math and I looked at what the total value of my salary over the next 5 years would be, the value of my options would be if we sold for like $1 billion, which is a fairly unlikely outcome. And I was like, okay, this is the number. And I asked myself, can I make that going to do something on my own? And, even at full value, which if you're being real financy about it, then you would have to put some some discount rate on it. Because if you think $1 million is how much you make in startups, to your earlier point about the failure rate, that's not guaranteed you're going to make that. So then there's some like percentage chance you don't make it. But whatever. I was like, I think I can do it. So I said, you know what? Here's my resignation. I am going to go bet on myself, which is exactly what you said earlier. And look, like, I'm not going to sit here and say like it is a perfect formula. Everybody who bets on themselves will see success. That is not true. Entrepreneurship is inherently risky. But there's no guarantee I would have gotten that paycheck for the next 5 years. There's no guarantee I would have gotten the value from those options over the next 5 years. There's no guarantee that they would have promoted me because they didn't want to promote me when I clearly killed it for them in 2 years. So taking the bet on myself was more so establishing and putting my foot in the ground of like, I know how much I'm worth and how much I've been able to create for other people. And it's time I do that for myself. And so I went to go buy a property management business. It wasn't exactly the same as the one I came from, but it was similar enough to where I understood the landscape of the industry. I understood the competitors. I knew who to call if I ran into trouble. And I was ultimately able to hire and like make good decisions on who should be on the team. And some people followed me from the last company. All of that translated to a more efficient business, a better run business, a fun culture that attracted the best talent. And that translated to us getting on top property manager lists and improving profitability, launching a new service that was really highly profitable, and then getting into a bake-off between two strategics to acquire our company, which ultimately translated to increased equity value. So I say all that to say, like, all of this other stuff that turned into cash in pocket for myself and my business partner was a function of me betting on myself. And you don't even have a shot at getting that if you don't take the shot and bet on yourself. And like, so I think you're spot on, Elliott, in terms of the importance of doing that. And, like, if you look in the headlines today, people are getting laid off left and right. Career control is not a given anymore, right? And I think that it is incredibly important, especially for minorities and people of color and Black people in particular in this country, to have some control and say over their career paths and their wealth creation. Because just to leave you with one other statistic, when we took over the business, there was 28 people, 90% not diverse, majority men. When we sold the business, it was 80% people of color. Leadership positions were all women, with the exclusion of myself and my business partner. But like, the people we were betting on for the future were women. The company was 60 or 70% women. And so just by the nature of our diverse, in quotations, ownership, it also provided a massive amount of opportunity for other people who have now gone on to do dope stuff. One person just closed her first acquisition because she watched us do 2 in the time that we were working together. So, what multiplying of impact, both on your own income and other people's trajectory, could you have if you bet on yourself? I think that's a question people need to sit with, man.
Yeah, I couldn't agree more. I see those stories all the time. I toss out a few other risk mitigating scenarios. So what if your net worth is low? What if
I'm gonna
you
say
had
that
a
in
tough
colloquial
time?
terms. What if you broke?
Thank you, Brian. Who am I talking to here? What if you're broke?
Yeah, that's real. So this is where I think deal structuring comes into play. So I was actually doing some math on the side here just to make sure I have my head straight on this. So I was thinking, like, okay, what if you are used to making $250,000, which is a lot of money already in itself, right? But I know when I was about to step off on this journey, I asked my wife, I said, hey, I'm about to do something. I might not make as much money as I used to. where is like the floor, like worst case scenario you're willing to deal with. And so the point is that like we had a discussion and there was some compromise we were willing to have, but it wasn't much. So let's say you're used to making $250,000. Typically, rule of thumb is you assume like a third to half of the cash flow of a business you buy goes to debt service. So that means that the minimum amount you need to have in cash flow to still pay yourself $250 is about a $500,000 company. So using the 3 times multiple you talked about earlier, that's a $1.5 million valuation business. That requires, if you use SBA loan and put 5% down, that requires $75,000. Okay, so that's a lot of money, right? Like, I remember when I first got out of school and got my first bonus, and I like mentioned to somebody else that I had like, tens of thousands of dollars in the account in my bank account. She's like, "You have $10,000?" And I knew I needed to shut up at that moment because I was like, "Oh, I'm privileged." So let's say you don't have that, or let's say you have 10 or 20. You are a sociable person. You are hopefully, as Elliott alluded to earlier, a competent person who has demonstrated a track record of some kind of success in driving value, executing things, or whatever. You have a network. When the first entrepreneurial venture I did, we raised a small fund, and I think we had like maybe 12 people invest in that fund, half of which were just friends of mine from prior jobs that I'd worked. And they didn't really believe in our investment thesis or anything, but they were like, "I believe in you, Brian." And damn it, we didn't lose their money. So that's a success. But
That's right.
I make the point that like I didn't have like a ton of money to put in. I put in what I had, but I had all these other people that I collected over time through my network and through just being a good person that were willing to write a check. So if you have the opportunity to buy a business, right, and you've demonstrated with some people a track record of responsibility, of competence, of production and performance, then you can go to them and say, "Hey, I've got this really awesome investment opportunity. Here are all the reasons why it makes sense. Here are all the reasons why we can be successful. If you want to hear what those are again, I want you to rewind and go back to how Elliott articulated it to the bank, because that's basically the same talk track. And then like I'm looking for 10, 50, 35, whatever the number is, and have them put in. Now, the natural follow-up question to that will be, well, Brian, then how much of the overall business do I still own, right? Can I still make all of the $1 million when the business pays itself off? And so I've said deal structuring at the beginning of this conversation. There are financial instruments and ways to structure the deal such that maybe they invest in something that functions like debt, so you can pay them off as well as the debt note. There are some things that you can structure where maybe the ownership percentage is as such as it needs to look from an equity perspective, but from an economics perspective, it maybe changes. There are also performance-based incentives that, like, if you are only 10% of the total capital, but then you hit this performance hurdle, like you take the business from $1.5 million of value to $2.5 million of value, then you get 20%, 25% of the total value, whatever. Those are all things that when you control the marketplace of investors, you can then pitch them and massage them into the deal structure that could be advantageous for you, instead of having to go out to like a broad market and just accept whatever anybody gives you. You can say, "Hey, this is what I'm trying to raise," and people will be a little bit more willing to be flexible with you because they trust you. So I wouldn't let not having all of the investment capital today hold you up from proceeding. What you do need to do is look in the mirror and your Rolodex and ask yourself, who here trusts me enough or believes in me enough to potentially write me a meaningful 5, maybe 6-figure check if I find the right opportunity that fits me and the investment criteria that would make sense. Is that what you see in your practice?
So I'm gonna take it up a notch. So I see that, absolutely. But I was actually going a different direction with the broke comment. So I'm gonna go to the barbecue for a second, Brian. I'm gonna go to the barbecue. We're all chilling, sharing information, drinks are flowing. All right. So potential acquisition entrepreneur, potential buyer. All right. Let me tell you some benefits of being broke. Because if you're richer, it's just better. But if you're broke, this is the benefit you get. All right. If you're worth $100,000 and you take on a personal guarantee and you lose, what does the bank have to take? $100,000. Not so bad, right? Because your guy down the street or your richest friend may be worth $1 million between all their assets, what they've invested, appreciation. Maybe they have some crypto. And so his bet is 10 times your bet. Your bet's only $100,000. So, hey, broke man, you actually lowered your risk 10x by being broke.
You need to
Second
clip
off,
that and put it on the internet. That's a great point.
second off, I'm fortunate that I probably do about 40 deals a year. And so I see a lot of stuff, and I'm very active in the SMB Twitter community. And so there is a group called Search Investment Group. Shameless plug, just because the way they've set this up is for you not needing a single dollar. So they're willing to take 100% of the equity capital risk in your deal. You put in zero. You keep 70 to 80% of the business. They take the remaining part, and you put in zero. So that first salary check that you get, you're at positive ROI. We're not even talking about in years where you might sell $1 million entity. That return will be great, but like day one, you're walking into positive ROI. You're also working into partnership with folks that are intelligent and have seen things. And so, hey, broke man, you got another benefit. This market is so frothy. People like it so much that they're willing to put up 100% of the cash for you to do it. And then Brian talked about, well, they own some. How does that deal with my returns? Well, here's another benefit of this SBA 7A program that's kind of weird, but you can use it to your benefit. So anyone who owns more than 20% of the common equity, look up common equity, just ownership of the business. Anyone who owns more than 20% has to put up a personal guarantee. Well, if I'm some rich Warren Buffett dude, some rich Jay-Z dude, I can't take on personal guarantee risk for one of my 20 deals in my portfolio. So now I have to own under 20%. If it's an entity like whatever investment firm, they have to own less than 20% of the common equity. And so now this program's constraint, broke man, plays in your favor because nobody can take more than 20% of your equity. And so now I'm being emphatic because some of us walked into our 30s without a dime. Some of us walked into our 40s without a dime. That doesn't prevent you from playing this game. The investors in this game love the game too. So it's advantageous for you, for them. And that's why this thing is swirling. That's why Brian and I are talking about it, because you need to at least know it's there. So that was my concept of being broke. Just, you're not even putting much up on the risk side of the table. Why not? You can go get your job back, a job back. You're gonna cry about losing $100,000, but you had $1 million opportunity. Shoot your shot.
Shoot your shot. Shoot your shot. Now, if I'm going to put myself in the devil's advocate position, I'm going to say, well, like that seems kind of shady. Like, why would they do that? And like, oh no, man. Like, I feel like that's not the kind of opportunity I get. Man, will they approve people that look like us? So, like, what do you say to somebody like that that's holding themselves back because they're just not familiar with that kind of opportunity?
So I'm gonna keep it real with you guys. You are extra fine today. I will tell you that me personally, I stopped being in the business buying part of the house back in 2016 when it was way harder as a person of color to walk into these places and get the same credit opportunities as others. And that's another story for another day. There were very few opportunities. In the past 6-7 years, it's wide open. And when I say wide open, I mean, the lenders who are doing these deals are on Twitter, are going to conferences, are interacting with people, are putting out content about deals that they've done. They are subject to, if they're funky with their credit processes, they're subject to public ridicule on these social channels that they use to market. And now the lenders who are doing these deals are more used to seeing diverse people. Every year I go to conferences for small and medium business acquisitions, I see more and more people of color, more and more women, more and more people that didn't come from really rich backgrounds. Now, is it a little bit harder? Come on now, everything is a little bit harder. So I'm not gonna sit here and lie to you, right? But there's plenty of examples of people who are out there. I mean, the list of Black business acquirers, not at like the end of their career, but like accessible 20s, 30s, 40s, is like really, really long now. Really, really long. People have made money off the investments they've made in Black business buyers several times. The other thing I'll tell you, you should feel comfortable asking your lenders or your investors that question. You might also consider, I'm gonna shout out Lisa Forrest at Live Oak Bank. She deserves it. She helps people close a lot of business. You go talk to Lisa, well, she's a woman that's been in banking and been a minority in that capacity for 20 plus years. She sees you coming in, you have a certain disposition that's not like the typical white male buyer. There's a person that has some commonality with you who she emphatically advocates for women business buyers. She contributes to stuff around minority business buyers. And Lisa's actually cool to hang out with. Brian, the private equity folks we used to know back in New York and Boston, they weren't fun to hang out with, were they?
Absolutely not.
These people are fun to hang out with. You can get to know them personally. So I say emphatically, I'll put it even stronger. I've never seen as many Black business buyers as I have in my portfolio of clients this year. It's been amazing. And I've seen these folks go through credit processes with banks, and I'm waiting for the call like, hey man, they gave me the oop-de-oop, man, or hey man, can you call your friend over here? And it's not happening. They're just closing transactions. So there's never been a better time to do this. That will be my answer to someone who is holding themselves back. Get to know the people who are making the loans, because they're public now. It's not some person in some towers you can't get to unless you get in the building.
Yeah, I agree with that 100%. I mean, I've been looking at search funds since, what was that? Like, let's say 2010, just for conservative. I feel like it's longer than that. And the change in the ecosystem just over that 13-year period is dramatic. It went from like a small group of experienced but very, very cliquey investors that some people would even call the search fund mafia, to now you have business schools that lead with entrepreneurship through acquisition as a focus for one of the tracks at their program, to established funds that exclusively do what you just said, which is, hey, we'll basically front you all of the money to buy this business. There are even quote unquote tech companies that will do this now and like are an exit partner to small businesses that are looking for people to come get equity opportunities to run the businesses. So you have like the marketplace has not been more open for people of color to find some way that feels comfortable from a risk adjusted perspective to take a shot and have control and ownership in a business that could be legacy defining for their families for at least a generation, if not more. So I think, to the spirit of your point, man, like, go do it. Take a bet on yourself, put the chips on the table, and look, like, you might fail, but all great things that are worth trying for require some risk, right? Like, you don't see people climbing mountains thinking like, oh, like I'm gonna fall on a bed of pillows. There's risk, but then they climb and maybe they don't get to the mountaintop, but they get 2/3 of the way there. And that's a pretty damn high way to go when you're climbing, man. So I would say just shoot your shot. And, if this doesn't work out, use it as a learning opportunity. It's like an MBA, an entrepreneurship MBA, as it were.
You're talking to two brothers who have failed in stuff that we've done in our lives and are both doing very well right now. It was painful. I wouldn't trade one of those failures at all for where I am now. And so it hurts sometimes, but go anyway. And then I've been talking about the self-funded search side of the coin. I totally am remiss about the funded search side. And so Brian and I are more self-funded. We're probably more on the risk neutral side of the house, but I'm talking to some folks that might not be that risk neutral. There are programs, Broad Tree Partners, for instance, I think it's Next Gen out of Chicago, where you actually walk into a $150,000, $200,000 a year salary for 2 years while they pay you to search. Well, let me take a step back. We went self-funded first because I think that's our orientation, but there's a funded search way too. And either you go raise the capital yourself from search fund investors, or you enter into an ever increasing number of programs that have set it up where you just apply. And if they like you enough, they bring you in. And you walk into $150,000, $200,000 a year salary. They pay you that for 2 years to go search for a business. When you find that business, they provide the equity to buy that business. And you earn into a certain percentage. It shifts, but I think it's in the 20s now, 21%, might be higher depending on the program, over how many ever 5 to 10 years that you're going to run this business. And not only did you put in no money, but you got paid 400 grand over 2 years to do this. So if you're more risk averse, like we have a mutual buddy who's looking to do this right now. And he's just like, married, kids, doesn't want to put all that risk on the table. So he's saying, hey, I'm willing to forego some of the equity upside to keep the salary intact, keep my wife happy, keep my kids fed. My downside is I search for a business for 2 years, don't buy one, and go back into the job market. And I get a non-zero amount of equity and all the support that comes from the other people that are doing the same. So you're not going to be on an island by yourself. There's so many people who are doing it. And so this may be the clip that we put at the beginning of the video when we post it, but there's a funded search mechanism that essentially is no risk. I don't see any sizable risk in that opportunity, Brian.
Yeah, I would agree with that, and I think you're right. I think the decision zero for folks is how much risk and how much capital are they willing to put at risk, right? And so if you are not highly risk tolerant in the sense that like you don't necessarily want to have income instability, and you'd like to have, you would trade equity upside for certainty or increased certainty of success in the resources and programs and stuff like that. I think programs like you just talked about are great. Like those are perfect. That's why they're there, right? Is to attract people who might be skilled at running these kinds of businesses. They've had the corporate and operational experience to understand what good looks like, but they maybe were hesitant because of the risk. Where Elliott and I sit is a good nexus between risk tolerance and skill set, right? Like, it's not negligible that between us, we've probably done like hundreds of like diligence reviews of businesses over our career, right? If not thousands. And so I know I often take for granted when I'm talking to buddies who are thinking about buying businesses. I'm like, oh, well, you just look at this and this, and then, you like have the draft contract for the purchase agreement and blah, blah, blah. And I'm like spouting off all this stuff that's second nature. That can be intimidating, right? So if you want help with that and are willing to trade off some equity upside, the funded search route is not only available and widely accepted, it is the original version of a search fund, right? That's like how search funds started, was people would raise a little bit of money from people that could help them find and run a business well. They would go do the work, then those people would fund you buying the business. So doing a self-funded search or a fundless sponsor, or however you want to call it, is higher risk and obviously higher reward. But different strokes, man. And like the form, so if you decide which of those paths you take, then all the other things can happen. But I wouldn't let fear of the risk stop you, because there are mechanisms in place that will help offset some of that risk. And you got Elliott, you got me. You look at my LinkedIn page, I got like a bunch of people just commenting on like black and brown investors and people who have bought businesses. There are lots of us out here who can help guide you in the right direction, even if it's just telling you you can do it, which I will tell you that right now, you can do this.
Totally agree. That's the lower risk option for folks. And so I'm kind of glad we went with the slightly more risk option, because this may feel like an easy downshift for folks. So I think it kind of worked out. I also want to toss in, a lot of people So one of the benefits of the self-funded side that you don't necessarily get in the funded side in the same way is the assumption is with self-funded, you buy a business and then you run it. So you buy with your money, you go to the business, you run it, you operate it. It's your investment and your job. But you don't actually have to do that. What if you didn't want to work in the business? What if that business wasn't when you knew all that well? So the additive nature of you being in it isn't all that great. What if the reason you want to do this is you want to spend more time with kids and family, and maybe your partner has a big enough salary to sort of make this work? You can buy a business, hire a general manager, or promote one from within. Now you're going to take less home, right? You have to pay that person instead of paying you, but you don't have to be the person that runs the business. So now when we talk about like autonomy, agency, work from anywhere, there are people who have bought businesses, installed a general manager day one, maybe haven't even set foot in the business since closing. The general manager's just crushing it. Probably a bit more active than that. Let me not tell a story.
Sure.
But they're not there 9 to 5, Monday through Friday. You know, when Johnny calls off, nobody's calling the owner. The general manager has very strong incentives, if you do this correctly, to grow the business as much as you would. It might be somebody who didn't have the same risk tolerance you did, but still had the ability to run a business. And so as we think about the different models of this model can be one where you actually buy and don't work in it. You could buy a business, and this happens too, Brian. Folks that have kept their job through the whole search, part-time search, self-funded, bought a business, installed a manager, never left their job, keeping their nice cushy salary. And now, just like buying a real estate property, you bought a business investment, and now you keep on going. Now, these things are harder, but I'm talking to folks who have done hard things in their life. So that's another way to think about this.
Yeah, I have a buddy who, you know, his background is in management consulting, right? Like McKinsey, Bain, that kind of thing. And he and a partner bought a couple of large accounting practices, completely different state where they live. So, you know, I make that point because the tax rules are different, the staff is located differently, the licensing requirements for them are different in the state. And obviously they don't really know accounting like that. So they bought it and did the exact thing you said, which is they promoted somebody internally who was kind of like an older accountant, was kind of tired of the day-to-day, but was a great mentor to everybody. And so established that person as the practice leader. So they're in charge of mentoring, quality review, and getting out there to like go to the golf course and meet people and bring in new business. But that person didn't have the risk tolerance by the nature of being an accountant to buy the business themselves, but he was very happy to step into a role with great incentives, and that changed the nature of his day-to-day. And so they now have let's call it a turnkey passive business with an active manager, and they can, let's say, play a board member role. I mean, they probably spend like 10 hours a week on the business, but you know, that's not 40, it's not 50, it's not a 70. And that business is running itself. And by the way, they used a 7A loan to get that one done. So to your point, like this is very doable. Like there are people, this dude was younger than me. So like cats do this and are doing it more. And all of these businesses are assets, right? Like the statistic that Brandon and I like to quote in Acquire 101, the like entry level course that we teach on buying a business, is that like 10 to 12 million small businesses are going to transact over the next 10 years because baby boomers are retiring. So there has to be one out there for y'all. I like to say, no, you only need one. So go find one. I mean, that's corny, but like, you know, you'll remember it now.
No, that's it. And you only have to do one of these correctly to put you in a place where you'll work because you want to and work on things you want to versus work because you have to. I also wanted to circle back to something. We were talking about the competency you build while you're on the job selling or operating or managing. And Brian talked about a run where he 20x revenue for a company. When you do that, you're going to look at it and say, hold on, man, how many of these 20x things do I have in me, before I'm not able to work, or I'm not in a position, or the stars didn't align correctly. And so back to that risk conversation, I want to circle back, not stay in this one too long, but I think we can transition. But I know some mentors of mine who have been operators at the same level in 4, 5, 6 companies, and 4 or 5x revenue for other people 5, 6, 7 times. And I think now, they're seeing the risk differently, different generation. So I'm not speaking down on anyone. I'm actually leveraging the stories they're telling me to make better decisions and sharing some of them with you, so you can look into your network and see if that's happening. They would have jumped at the opportunity to put 5% down on a business that they could run, to not deal with the shenanigans of management, the stuff that people get put through when they get up higher in these companies. And even if it took them 2 or 3 chances to get that 5x run, that 10x run, they wouldn't be looking at it saying, gosh, man, I 5x for 5 different other owners and didn't get a piece of it. I just took home my salary. And then they don't even thank me some years for that 5x that I did. They make me cancel vacations and don't pay me bonuses. So something else to think about.
Yeah, I agree with that 100%. I mean, you only get one life, right? And if value creation for your family is a key part of that, ownership has to play a role in your strategy here. And to the spirit of your point, man, we can get off this, but like, I mean, I experienced burnout after doing this, right? And it was accumulation of having done a 20xer and then like tripling the value of this business and all these other things that happened successively. And that took me, I had to sit down for a year to recover. And, time value money, a year of my time is worth a lot of money. And, thankfully I was in a position to do that. But look, like during that time period, my dad passed away unexpectedly. So we don't know how much time we actually get. And I think that if you feel the capability of being able to triple, 5x, 10x the value of a business, should try to do that for yourself. Because I said earlier, if somebody's willing to pay you this, they're getting some multiple of that back into their own pocket. Why shouldn't that be you? And 2, you don't know how much time you have. So you might as well try and start the clock on your success, right? Because like success comes once you start, and keep going. But if you don't start, you can't get to the finish line. So I would just say start. I'm always gonna say start.
As you should. And then I had to take a year off too. I experienced burnout. And so I wanted to say that emphatically because people don't talk about that stuff. Not sitting out because I like beaches and rooftop bars. No. I'm talking about sitting down on a bed or a couch, rethinking life, not being productive, dealing with pains of sort of cumulative work and strain. And now someone may be thinking, well, heck, man, I don't want to go through that. So I don't want to. Well, I've seen people go through burnout on jobs. I've seen people go through burnout because they got fired and couldn't find another job. I've seen people go through burnout because they like nice cities and all of a sudden the only opportunity is in the middle of Iowa or Idaho. And so I'm saying that you may go through some places that are challenging. I'm a huge mental health advocate, so make sure that you have sort of your fortification around that stuff if you're taking entrepreneurial risk. But I'll also tell you that some of the same skills that you build in entrepreneurship help you get through stuff like that. And on the other side, I'll tell you, I recognize now the fight that successful entrepreneurs have been through generally. Like if I sit in a room full of entrepreneurial folks, people don't always share that they had their burnout or they almost lost this, or, you know, partner almost left them. But you kind of know they have those stripes because they bring that kind of power, that kind of force, not overpowering, overbearing, just that stoic power every day. And so I thought I'd be remiss if I didn't toss out there that you know, sometimes you can reach a place where you're not able to function fully because you work so hard, right? And fortunately, I was in a place I could take a break, you know, for a year. And you can take a break for a year or two and still go crush it. You only need one. I like that, Yono.
And if you own the business, you don't have to ask your boss to reimburse mental health support. So just another reason to own the business, guys.
You know what? That's something else to say. So if you own the company and you come to a place where you need to take a break, you actually have the ability to do so. You could start owning and running the business and then have an extra kid, you know, someone in your family gets sick. And you say, oh man, I'm willing to forego the 10%, 20% growth that I was pushing through this thing to just get my number 2 person to run it because I need to go do this. And you don't have to ask the boss to do that either. You can sell the business ahead of a difficult time you may be having in your life. You have all this flexibility. You can sell a portion to someone to come in and run. You have this asset that, just like a real estate property that you might own, you have control over all of the elements of what you do with it, including, I'll put this out here, a lot of us have highly qualified folks in our networks that for whatever reason can't get a job. You ain't got to ask nobody if you can hire them either. If they have a sales skill, an operational skill, with maybe a blemish on their record that doesn't enable them to actually use that skill to its highest valuable sort of job, you have the ability to hire folks, even if they do 20% less than somebody. Like, you're the only one that owns that little dip. And so there's a lot of reasons, both monetary and sort of personal, to consider this life. And so I think the reason Brian and I are talking about this is so you may know us and may have the impetus to go take a look and just see if it fits you. Or maybe you call your friend who it fits better. But I wanted this knowledge, I'm sure Brian did too, to permeate in our communities as loud as it's permeating in others.
I'm with it, man. I really appreciate the opportunity to talk through this, Elliott. And I feel like we've covered a lot of topics that hopefully folks had on their minds and are no longer worried about. So, you know, if y'all have questions, the one thing Guardian does really well is answer the questions that matter to figure out if you're going to buy a business. So you're talking to the right guy.
Brian, very nice. I do try my best to answer those questions. I'm also accessible on my website, Guardian Due Diligence. And my bet is that Brian will increasingly be a person that uses his voice to sort of push this information out as well. So I know Brian well enough to say this for him. On topics like this, you know, we're going to try our best to get you an answer or point you in a direction. So thank you for spending some time with us today. And until the next one, see you around.
Right on.